Good morning. I'm Jason Schloetzer, chair of the accounting department here at Georgetown and a faculty affiliate of the Psaros Center. And I'm very glad to welcome everybody to the panel session on market microstructure, which will be moderated by Stacey Cunningham, a board member of the NYSE and also a member of the Psaros Center's Board of Advisors. And today's panelists are Hope Jarkowski, who is general counsel of the NYSE Group, Brian Schroder, president and CEO of Binance USA, Jim Angel, associate professor of finance, and also a faculty associate of the Psaros Center, and Nandini Sukumar, CEO of the World Federation of Exchanges. Stacey, we look forward to a delightful panel discussion, and we welcome questions.
Thank you. Thanks so much. And I first off just want to say thank you again to the Psaros family for making all this possible and really taking this center to the next level. And I also want to thank Professor Agarwal because I share her passion for the value that markets can deliver. And our capital markets have really been the engine that have powered the growth of this country. And we got to get it right. So we need to make sure they continue to work for everyone. And I appreciate the work that the center is doing to advance those goals. And that's why I'm excited to be part of the advisory board and here today moderating this panel. So I'm going to start off with a yes or no question, super easy. If somebody handed you a blank piece of paper and described today's markets in the US and said, draw a regulatory structure, would you draw what we have today?
No.
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 No. Okay, so we have different regulatory bodies regulating different entities with different standards. Even within the same asset class, we have the same kind of activity that is regulated differently based on where it occurs. So we have exchanges, ATSs, and wholesalers all matching trades with different rules and different levels. And I'll start off with you, Professor Angel. Is it possible that we would see a regulatory overhaul? Is that what we need, or do we need to keep working through what we have?
We desperately need a regulatory overhaul. We need to rethink the structure of US regulation. We have hundreds of regulatory bodies at the state and federal level, and quite frankly, they don't play nicely with each other. Now, there's a lot of pessimism in Washington saying, nothing will get past the Ag Committee. But I think we need to take a longer view. We need to have the discussion. We need to bring all the stakeholders together, come up with a consensus for a regulatory structure that fits a growing economy going forward. Now, this is a process that's going to take years of deliberation, negotiation, but it's the kind of thing that if we don't get started now, it'll never happen. So yeah, we need to get started, even though we know it's not going to pass in Congress this year. But we must
is that one
start
regulatory body, or is it still to separate agencies looking at different elements of the market?
Well, I don't know I don't have the exact solution here. But as the last panel pointed out, the US does have a long history of copying what the UK has done. But we usually take 30 to 50 years to do that. And so I think Twin Peaks is something to look at. But we also need to take into account our history of a federal system. We need to have a good discussion about what's the right role of state versus federal regulators. And we need to really rethink the entire structure. What's the right role of SROs? We need to rethink all of this, but we need to start now with the discussion.
So Nandini, you have such an interesting vantage point overseeing, working with 250 different exchanges around the world. What are the lessons that we should be taking from what works and what doesn't? Is the professor right? Is it the UK who has the right model?
I think that's a fascinating approach to take. But the reality is that there is always what we call global regulatory fragmentation. So it's fascinating to hear the conversation here in DC with all of you where we're talking about federal versus state, whereas regional, etc. And at the global level, those exact same conversations play out, but you can insert different names there. So within even the global regulatory structure, you have, of course, the global regulators, the likes of IOSCO, the Basel Committee, the Financial Stability Board, and then you have domestic country regulators who sit within that structure. And if you ask the CFTC and the SEC if they'd like to be considered domestic country regulators, I think it would be an interesting response. Is the FCA, is ESMA, are these domestic country regulators? So I think we spend so much time, especially as an industry, that's a highly regulated industry, exchanges and CCPs. We live regulation, we embody regulation. You know, that's our DNA. That's what makes us different from many other parts of the ecosystem. And I think we spend so much time trying to kind of bring together these different pieces of regulation so that there's less fragmentation. We live with fragmentation of liquidity on our markets, and really live also as an industry with regulatory fragmentation, and neither of those things, neither the fragmentation of liquidity particularly, and certainly not, you know, global regulatory fragmentation, are particularly helpful.
Yeah, I think we talk so much about regulation because regulation and market structure are so intertwined. I mean, this is a market structure panel, and we could not have it without discussing regulation, because really it's all about a reaction to what are the rules of the road and how do they apply. And that fragmentation that you mentioned, we're seeing those results in the market. I would argue that the market moved 1,300 points yesterday because it's fragmented and you don't have centralized liquidity in certain places. But we know that we're trying to respond to the rules and build businesses out of that. In the digital asset space, crypto space, perhaps it depends on who you ask whether or not the rules are clear. So we've heard repeatedly from the SEC that the existing rules apply to digital assets and to crypto. But there are obvious spaces where that they couldn't apply because there's just not a one-for-one equality. How do issuers file? What kind of disclosures are there out there? So do you feel like the rules are clear and you have everything you need?
No. So I've been CEO of Binance US for over a year now. And one of the first things that I did as CEO was hire over 30 years of SEC, DOJ, and New York Fed to report directly to me. And the reason that I did that is because it was not clear. There's actually greater clarity for us at the state level. And so we have gone through the process of actually going and getting our money transmitting licenses at the state, territory, district level. We have over 41 today. But what that means is we have 41 different regulatory bodies that we had to submit applications to. We had to have discussions with. We do, quarterly data reporting. The MTL is something that needs to be reviewed every year in order to keep it. And so, there's this myth that crypto is, a wild, wild west, but we're actually heavily regulated already.
When you think about innovation, I mean, regulation typically lags pretty significantly innovation in the market. And we've seen that repeatedly throughout history, no matter what you're talking about. I mean, the automobile was made mainstream with the introduction of the Model T in 1908. And it wasn't until 1968 that we saw seatbelt laws. So you might have to wait 6 decades
I know.
to get a little bit more clarity.
Yeah, exactly. And so my background is technology. And so we try to move at the speed of technology. And so talking about regulatory frameworks for crypto based on a 1946 case about oranges, before the microwave was invented, before the transistor was invented, before literally a cooler was invented, doesn't feel right to me.
Yeah.
And this is something that, I have some experience with because prior to Binance, I was at Uber. And I think that there was actually a lot of similarities between.
Yeah, I was going to say, it went through the same thing where the market demand drives a lot of the
absolutely, right? And so, the case of Uber is basically innovation, technology, innovation, getting ahead of regulators, right? Regulators never contemplated a stranger getting in the back of a stranger's car. That just didn't exist. And so, regulators did not contemplate the idea of a digital store of asset. And so we're going through this period of time, just as we did with mobility and transportation, where regulators and innovation are starting to, catch up together. And so there's a lot of great work and a lot of work being done in the House and in the Senate that we're very supportive of.
But when you look at the regulatory clarity that exists in the digital asset space compared to the traditional finance space, what do you think is most glaringly missing?
So I think it's around clear definitions, right? And so I think that the Senator Lummis and Gillibrand, I think that their bill, the heart of it for us, right, is actually putting in clear definitions of what is a digital security, what is not. And then beyond that, I think that it's Congress's, remit to actually define what the regulatory body is that will oversee these different definitions. And I think that, my belief is we will get to a place where the SEC will have their clear regulations over crypto, the CFTC will have their clear regulations over crypto, and then the states will also have theirs. So I will be a very busy, person.
Yeah. Well, and I think it's interesting to see because we've certainly seen in the traditional finance space that regulations don't just apply to the different asset classes that are traded, but also participants. Like how are different participants regulated differently? And Hope, I'd be interested in your perspective, given the fact that we've had over 200 years to get the regulation right in the equity space or option space, where we're still debating all of those elements today. And are you excited about that?
So, we play on a competitive landscape on very different terms, and we're regulated in a far different way than our competitors who are not national securities exchanges. And there, in some instances, it's completely appropriate to have different regulatory regimes. In other instances, when you have the same behavior in the marketplace, one could argue that it ought to be regulated in a similar fashion. So in many instances, we are hamstrung in our ability to innovate and our ability to react to market dynamics because of the regulatory structure that we enjoy and also don't enjoy.
I just wanted to add to that. I think, you say that, you've put that very well. If you look at, let's look at, the digital asset space or the crypto space, all market infrastructures, all exchanges, all our members around the world are looking at a way to bring that, into an exchange traded environment. And I love the word that you use, hamstrung, because it's absolutely that. Because when you're an exchange, when you're a regulated public marketplace, your approach is you set off to solve the regulatory piece at the heart of the puzzle, and then you create the product around that. And so that, in essence, I think, evokes some of the challenges that a regulated public marketplace has, in coming forward with new product, with innovation, etc. And of course, at the same time, you have all the background, shouting, "You're not the cheapest option. You're taking too long to do anything about this. Oh, you guys are all slow and sleepy." So I think recognizing that with every kind of new paradigm shift, if you like, or anything, you really need to start by being able to solve that regulatory puzzle before it's innovation.
I completely agree with that. When you think about the role of the SEC and the mandate, that largely driven by protecting investors and specifically retail investors. So I think we really need to talk about the retail investor, because they have played a role front and center over the past couple of years, more so than even before. When you look at meme stocks or digital assets or payment for order flow, all of these topics are really centered around the retail investor and how that's evolving. So Hope, I'll start with you. You are here representing the world's largest exchange, and yet most of the retail flow doesn't go to the exchange. So is that, what is that dynamic like? And I mean, you talk about being hamstrung to compete for retail. What are some of the things that could change that would allow the retail investor or allow perhaps more market participants to engage with the retail investor? And is that working today? Do they have it as good as some say?
I mean, a lot in that question, but you're right. In the last 2 years, retail participation has been at an all-time high, and seeing investors engage in the market more than ever in some instances is very encouraging. I mean, it's empowering to see investors have that access to opportunity. On the other hand, there are many days when retail trading in some symbols is over 70%. And on the whole, the TRF, the trade reporting facility, which represents off-exchange activity. The last time I've seen is something Chair Gensler, I think, referenced a 35% number. I can't remember the last time I saw a 3 in front of it. So, 40 and above is regular course, except on days where it's very volatile in the market. Then you see the exchange market share, people coming to the central place of liquidity where there's transparency. On those days, the public exchanges have very strong market share. So it's interesting dynamics.
Well, the risk profile of providing payment for order flow is a little bit different on those volatile days. So suddenly that order flow finds its way back to a lit market.
Precisely. And, from the New York Stock Exchange perspective, we have a unique market model where we incentivize the displayed liquidity was designated market makers on our floor. And so that is an element that you see play out in a very real way on days like when it's particularly volatile.
But one of the reasons why you don't see as much retail trading on exchanges is exchanges don't have the same, at least in the US exchanges, don't have the same access to price levels that others do. And so I've seen that NYC has a proposal out to harmonize that. So price improvement can be offered on the exchange as well as being off exchange also.
That's right. I mean, it's a living and breathing piece of Reg NMS, which, again, it's been a really long time since Reg NMS was adopted and implemented. So as the markets have changed, so too should the regulations be revisited. So we think that a modest adjustment that would include harmonizing tick increments on and off exchange for different size securities, liquidity, we're sort of agnostic as to the risk, as to the profile of what would be included. But we believe strongly that a harmonization of increments on and off exchange would go a long way to advance the access, the concept of institutional inaccessible liquidity, people not being able to interact with public markets because they're not able to from a price increment standpoint. And then there would be other adjustments to correspond with that, including things like access fees and other financial incentives would have corresponding adjustments.
So Brian, the digital assets, cryptocurrencies are earlier in their stage. Describe the retail institutional split, what that's like in your world.
Yeah, so for us, I think we did about $800 million worth of trading yesterday. And about 70% of that is actually institutions, 70 to 80% is institutions. So institutions drive disproportionately the amount of trading volume on our platform. But retail is an extremely important segment for us. And I think that what's interesting is that a lot of people confuse us with the kind of Robinhood models of the world that do have the payment for order flow. Binance US, we actually have our own order book. And if you go into the app, you can actually see it in real time, which is pretty amazing. And so when we announced kind of first in the world in June that we were going to a no-fee free Bitcoin trading, people, reporters came up and said, yeah, but you're making money on the payment for order flow. And I had to tell them, no, I am not. It's literally, we don't make a cent on our Bitcoin trading. And I think that is more of an education thing to saying that effectively payment for order flow on kind of our business is not something that's actually happening. It's a true marketplace.
It's interesting to see. I know Chair Gunzer spoke this morning about payment for order flow and the role that plays in the market toward competition. I'm curious what you think, any of you, on we haven't really seen that specifically as part of the proposals that might change or where we ought to go with that. Is it a good thing or a bad thing?
Well, what concerns me about the tone of what I heard today from Chair Gensler and Director Xu from Trading and Markets yesterday is that there's this emphasis on process and not outcome. As a retail investor, what I care about is how good a job is my broker actually doing. What I would like to see is Rule 606 updated so that the brokers will tell me how good I'm doing. I don't really care how my broker executed my trade. What I care about is how well they executed the trade. And since transparency is at the heart of our philosophy of regulation, it worries me when I hear regulators talking about micromanaging the fine details of how we execute orders. I don't think that's going to work out well.
It certainly keeps us on our toes when we're looking at all that. And I would argue that payment for order flow has really done a lot for competition at the order level and perhaps given retail investors better executions at a specific level, although arguably they could get even better if others were able to compete. But at the ecosystem level, being so fragmented and centralized in a few different places that are not lit and transparent does lead to a lot more volatility in the markets. And it's hard to deny that. Let's talk about ESG. The next panel is going to talk about ESG. And I think it's interesting to see how much of a focus ESG is on the SEC's agenda, on its very important focus to listed companies and their investors. What should exchanges be? What role should they be playing in that? I'll start with you, Nandini.
So the most interesting part of the ESG puzzle, if you like, is that exchanges have actually been working on it for the last 15 years. So when we think a little bit, what we've seen over the last couple of years is the mainstreaming of ESG. But every exchange across, our 300 markets at the WFE, has been promoting disclosure, good disclosure, greater disclosure, data, attempting to find ways to make things in the data comparable, etc. And also on a very fundamental level, trying to solve some of the problems. So the whole kind of conversation around ESG is in part about trying to solve problems. And the exchange is very well placed to solve some of those problems, not only through greater disclosure and data, et cetera, but through actually bringing product to the market. So if you look globally, I mean, probably the fastest growing product of the last 2 years, every year for the last 2 or 3 years, has been green bonds. And especially over the pandemic, they're still a small part of the overall bond market, but they have been across every asset class, in percentage terms, the fastest growing asset class, so green bonds. And then you've seen through the pandemic a greater granularity of that. You've seen social bonds, you're seeing gender bonds, you're seeing all kinds of cool bonds. So exchanges are well placed, looking at the carbon markets, because now we're seeing really the beginning of an emerging public market in carbon, right? So exchanges are incredibly well placed to provide solutions to solve some of the problems, because ESG is about solving problems. If you think as well, going back, and this is why I said exchanges have been working on it for the last 15 years, the G, which is not the one everyone talks about so much at the moment. The G has a traditional function of the exchange. And, Rena has written a lot of the kind of seminal work on the subject. And the G has been something that every exchange works at and looks at from the minute you have a listing function.
Mm-hmm. You could argue that it really should be GES and that the governance really needs to drive everything else. If you have the right governance structure in place, the focus will lie appropriately on environmental and social issues as well. But the exchanges have traditionally focused more on the G and less on rules and disclosure obligations around the E and the S. Is that where they should be heading? You talked about product solutions, but should it be rules-based or product-based?
So that's a fun question, because across the 300 markets of the WFE, you see all kinds of different models. And I'm going to be disappointing by not giving a yes or no answer, but saying that we all live the fact that what's right for one market is not necessarily the perfect solution for another. So it always needs to be rooted in the needs of the domestic market structure. So sometimes it's product based. If you look, and I'm going to take you all far away, I'm going to take you to Africa, where there's been a really successful fixed income product. It wasn't particularly touted at outset as a kind of ESG product, but it is. And it was a way to tap domestic savings. And it was a small bond that you could buy. It was almost like a post office bond. You could go and buy it, in your local post office in an East African country. And people were putting, at the end of their monthly wages, you could put, 50 quid in it, if you liked. And that's a classic example of an ESG product. It was often women's domestic savings that went into that product. And that's a classic example of how you're beginning to solve many issues, through a product.
Yeah, that's fantastic. And letting the markets be a solution and provide opportunity is certainly a thesis.
And it was traded on the exchange. So, the investor had transparency, they had the comfort of regulation, they had the comfort of a clear and published rule book, should they wish to read it.
Yes.
They knew that there was going to be, investor protection was at the heart of that model when they came to trade that bond. And they believed, if you're going to trade on a market, a public regulated lit market is the safest place that you can trade.
So ESG has obviously been a focus for the exchange for decades, but now much more formalized and broadcast as issuers are working on it. What does the NYC view their role could be or ought to be?
Yeah, we are in the midst of a total evolution of how issuers are thinking about this. Our issuer community is in an unprecedented time of shareholder engagement. They're looking for solutions. They're looking for ways to advance the interests of their own investors and their own public company profile. So we spend a lot of time thinking about what role does the exchange have in that. We obviously have listing standards, and we've had them for quite some time. But what are the other ways that we can essentially match a buyer of an ESG principle with a seller? And so we have adopted an approach that may be different than some of the other global exchanges, which is, harnessing that matching function. So if people are looking for board candidates, we have a board advisory council, which is, matching issuers with diverse candidates. We have sustainability advisory council, which matches chief sustainability officers of our public companies with each other so that they can talk about best practices. So we've adopted more of a tools, not rules approach at the NYSE, and we continue to be in close contact, with the SEC on all of it. Similarly, we also are always looking for opportunities to expand what we list and trade. So in the natural asset company space, we have some work that we're doing there. We have all different types of ETFs that are looking to come to market. So, we're about introducing opportunities for investors to get the broadest array of products possible, subject to SEC approval.
It keeps you competitive. It makes it a competitive focus and market focus, which I brings me to global competitiveness and what we're seeing around the world. So the US, both regulation and legislation, has looked at strengthening some of the laws around Chinese public listed companies in the US. Talk a little bit about that and where that is and what that might mean.
Sure. I mean, it's, been a topic of great discussion for
I was understanding at a prior point.
Yes. And as Chair Gensler aptly said a few weeks back, we now have a program in place where the PCAOB is on site in Hong Kong inspecting Chinese company audit work papers, but the proof isn't going to be in the pudding as to what that means with respect to their ability to come into compliance with Sarbanes-Oxley and the audit structure that's mandated here for US companies. So that is, an unknown, and we're very focused on that and watching how that develops. But more globally, the biggest competitors for us are not other domestic exchanges. It's the private markets, and it's to some degree exchanges in other countries. But from a global competitiveness standpoint, I think we're very focused on how to maintain developments in the public market space as opposed to the private market space, which is more competitive than ever.
I think that's absolutely at the heart of the conversation now, especially as we come out of the pandemic. And at the WFE, we're looking a lot at private markets and public markets. They're complementary. No public market wants the private market to disappear. But really what we should all be thinking about in this room and talking about is, are the incentive structures right? At the moment, it feels like so many of the incentives are to push, to favor or to push investment companies, keep them in the private markets. And I don't think that's necessarily the best outcome for the long term. And if you look, a classic example is actually in ESG. Everyone's coming out and reporting, saying, oh, we're going to have ESG disclosure rules, and so if you're an investor, you're going to get all this great data. And everyone says triumphantly, oh, and it's going to apply to all the companies listed on the exchange. And I use this as an example because climate is a good example. If we want to solve for climate, how can we solve? Only by looking at the fraction of companies that come onto the public market. The other point as well, looking and private public flows across many themes. If you look at OTC and exchange traded, you look at traditional assets and non-traditional assets. And if you think about all of those things, the markets you started off, Stacey, by talking about the kind of interconnection between regulation and the exchange. And there is a similarly profound interconnection between private and public markets. Yes. The health of both depends on the health of the other. But at the moment, the incentives are tilted away from public markets, and that long-term is not healthy. And that's something all of us here in this room together, with Rena, And, the Psaros Center, and you yourself bring a wonderful perspective on that, coming from the background that you do. That is something we should all be trying to solve. And it's not a zero-sum game.
No, you have to think about the ecosystem. And when you think about public versus private, and you're looking at regulations that you want to introduce into the public markets that seem great. And if every company just did this, it would be better for everyone, but not recognizing that companies have choices and the market will respond and the market will react. And so if you make it so difficult to be a public company, and there's access to capital in the private markets, which there is more than there ever was before, companies will just choose to avoid them, and you can't blame that. And so that global competitiveness, whether it be China or others, go ahead, Brian.
Yeah, no, companies have choices, but also industries have choices.
Yes.
And I think that one of the greatest potential gifts for the United States was China's regulatory crackdown on crypto, basically made it completely illegal. And so what that has done is the people who are innovating in China have now dispersed, and many of them are coming to the United States. And so we are a US-based company. We license technology from the Binance International. And so we are very pro-American innovation. And what we want to see is we want to see a regulatory framework that allows innovation to thrive. Because if you don't, then America innovation will go away and it will go to Europe. Right.
Yeah, and even within America, you just moved to Miami. You look at the you can't take your position for granted. And I feel very strongly that Amsterdam was the financial capital of the world until it wasn't. And then London was the financial capital of the world, and New York is the financial capital of the world. But we can't assume we're going to keep that here in the US or specifically in New York at all. And we're already seeing a lot of companies choosing to go to jurisdictions that are welcoming innovation and ready to react to it and respond to it. So with that, I know I wanted to leave a few minutes for questions at the, and I think we're right. Any questions? I have more. Okay, well, if anyone has a question, just.
Looks like one is approaching.
Oh, yep, go ahead. Yeah, just up to the mic, it's fine.
Or from here. So thank you so much, first of all. Hi. That last point about regulation versus innovation is particularly interesting, right? Because there is a role that regulation can play in driving everything we're talking about ESG. So I'd love to hear the panel talk a little bit more about what that line is and how could we think about it intelligently in the United States.
Anyone want to start?
Well, I would like to echo what you said about the choices that companies have. Now, I'm a big fan of disclosure, of making companies disclose what they're doing, but to allow private companies to do dirty deeds in the dark and putting all of the compliance burden on public companies is really the wrong way to do it. So the question I keep asking is, why aren't we doing this through the Environmental Protection Agency? And why are we doing it through our Securities and Exchange Commission? So that's how I approach it. We definitely need better disclosure, but I think we're going about it the wrong way in the US. So I think we can do things a lot better than we're doing now.
Just globally, I mean, the point you made about disclosure, is so profound. I think we are approaching sometimes disclosure wrong. I mean, we focus so much on disclosure on private companies. Really, what we need to do is improve disclosure across the ecosystem. So if private companies had to disclose more, it would be better for the health of all. I mean, we always talk about, there's always this debate, well, in public markets, is disclosure, is there a race to the bottom and all this? And I always say, no, that is not the solution. You have to have a balance between disclosure calibrated at a point where a company still wants to come and list. And you also want to be in a place where disclosure is a powerful and effective mechanism for the investor. But that needs to occur, as I said, with the ESG example, across the board. We should improve disclosure in private markets.
Well, we are seeing our public companies play the role that our government used to play in many ways, and having things done at the government level and perhaps small versus large instead of public versus private be the barrier for where you have certain disclosures. Because it is hard for companies to disclose all these things, especially when they know they can get in trouble if they got it wrong accidentally.
It's
it's,
hard for investors to understand.
and it's hard for investors to understand. So having simple
Overload
standards.
is when you have too many choices, you can't make a choice. So I think information overload is a significant problem. And our issuers, feel it intently every day.
Go ahead.
Professor Angel, you mentioned some of the challenges that come when there's overlapping jurisdiction of different regulatory agencies, whether they're on a national or state level. Looking towards the future and making the US well able to address financial innovation as well as innovation in other group areas, do you think in terms of an approach, would it be more effective to consolidate authority within regulatory groups or have more specific designations of authority, pardon me, to other groups to put the US in the best position to move along with innovation in the private sector, like what Binance is doing?
Yeah. Well, historically, we've had institutionally based regulation. If you're this kind of bank, you're regulated by that regulator. If you're that kind of insurance company, you're regulated by those people. And I'm a big fan of actually doing things with functional regulation so that we don't look at the label of what you call yourself, but instead look at the label of what you're doing. So if you're selling financial products to investors, you should have a consistent set of regulatory guidelines. And it shouldn't really matter whether you call yourself a bank, an insurance company, a commodity firm, or a securities firm. So that's how I approach it. I think we really need more functional based regulation rather than institutional based regulation.
And I would say as an exchange, right? To the extent that you have clear, consistent, and ideally standardized regulation, because going to 41 different regulators with different forms and different reporting requirements, and it is a substantial burden on the business in terms of total cost. And I think it would be impossible to set up an exchange now because we've spent tens of millions of dollars being compliant. 20% of our US-based staff is in the compliance department. It's just a lot of work.
We really feel your pain because there are, most exchanges now, mid-size and the large ones all operate, globally. And we live that burden and have lived that burden for decades, because you are still as an exchange liable in every single jurisdiction. So it is part of, the responsibility of being an exchange, I think, dealing with that regulatory fragmentation.
Yes, and having to ask for approval in advance of doing
Exactly.
anything once you're in exchange versus innovating on your own timetable and then having your competitors be able to do the same exact thing.
It's not innovation if you break the rules.
Yes.
Which is what I meant when I said, you have to solve the regulatory piece before you can call it innovation.
Yeah, exactly. Bye.
Hey guys, the chairman's been pretty vocal about changing the equity market structure. One of the big things he's been talking about is auctioning off retail order flow. How would you envision that to work? And is that the best thing to be doing with retail investor orders?
When I was hanging around NASDAQ, I spent a lot of time in the economic research group where we were working on the opening and closing auctions. And one of the takeaway lessons was just how complex auctions are. There are literally dozens of different design decisions on who you let in, what kind of order types, what kind of information do you give out, when do you give it out. They're actually quite complicated. So they sound great in theory, but in practice, they often result in dislocations. If you notice what happened when Tesla was added to the S&P 500, the closing auction price was over $20 different from the price just before and just after the auction. And indeed, academic paper crossed my desk this week, looking at the numerous dislocations in various closing auctions. So I don't think that auctions are a panacea, although some people think they are.
Hope, how about you want to tackle that one too? Should be auctions for retail?
Well, I think, there's this functionality exists in the options markets. So, to the extent that regulators are looking for a model to utilize in the equity markets, I think we would caution against, having it try and be a one size fits all across asset classes. But I would be remiss if I didn't tout the benefits of the NYC closing auction, which is the largest global liquidity event every single day.
Well, and it works differently than some other auctions. And that transparency, I think, is what's important. And frankly, I think through all of these topics that we're talking about, every single one of them, trust is the underlying most important thing we need to protect in our markets, because that is what makes them the most liquid markets in the world, is the trust that we have. And we have a crisis of trust on a number of fronts. And you certainly saw that with the meme stocks. We saw retail investors feeling like the system is rigged against them, and so taking it into their own hands in their minds. And that's something that we need to address as an industry. I'm really excited that the Psaros Center is focused on education as well, because making sure that retail investors understand how the markets work. And this comes from someone who got personal emails from retail investors whenever the markets go really, really haywire. And they're begging for help, saying, I didn't realize this could happen. How can we fix it? And that, I think, is on us as an industry to make sure that the retail investors understand the risks they're taking in the market.
I just remember during meme stocks, and we had a call, and one of our US members mentioning, they said, this morning they're reporting that someone's committed suicide. And I think it just kind of really brought home the tragedy of what can sometimes happen, when you lose investor trust.
Yes, and that retail investors, it might be their only trade of the day. Professional investor can recover from market moves because they're making tons of investments all the time. When it's your only investment and it goes against you in a very volatile way, that's why I do think we need to address the fragmentation that exists in the market. All right, I think we are up on time. I want to thank the panel for all of your insights and varied viewpoints, and turn it back. And we're off to a coffee break.